That's the closing bell on Wall Street, and now it's market domination overtime. Markets closing lower, and we have some breaking news. President Trump has chosen a temporary replacement for Kuglar's position in the Fed. We're giving you full team coverage of all the moves to get you up to speed on today's action. Interactive Brokers chief strategist Steve Sosnick is here, as well as Yahoo Finance's Jared Blickery to break down those moves. Jared, let's kick it over to you. What happened today in the markets?
Well, we had a mixed day. We started to the upside, finished to the downside in the Dow, but it was not the same story in the NASDAQ composite here, and this should be good for a record close, 21,243, and we are seeing it up about 35 basis points or 1/3%. We'll also check in on the S&P 500, just barely down by about 8 basis points. Nothing to write home about there. We have been seeing volatility creep a little bit higher, but still off of the highs that we saw last Friday there. And just checking in on the bond market real quickly. We had a 30-year auction today, was a little bit weak in demand, and we saw rates rise a little bit, but that was kind of a non-event as well. Now let's get into the sector action where utilities and staples were leading the field, up 1% and 0.75% respectively. Also seeing XLB, that's materials, real estate, and then tech in the green. To the downside, we had healthcare and financials each down more than 1%. And if we take a look inside the NASDAQ 100, we can see a lot of green on that board. Apple, we've been through the story before, that's up 3% today. NVIDIA up 0.75%. I was showing our chip board earlier, lots of green there. You contrast that with what we saw in software. That's a pretty stark comparison right there. ServiceNow down 4%, Salesforce leading the Dow down 3%. And speaking of the Dow, let's just go right over there where we see a little bit more red than we did in the NASDAQ 100. And I'm going to show you the Dow transports. We were just looking at the industrials. This is the transports, even more red. So a lot of the losses centered outside of tech, but that was one of the bright spots in the market today. Josh.
Steve, your thoughts on today's market moves?
Well, I think we got a bit of a head fake in the morning, and then reality set in. I think we had the usual chase in the AM, and then I think the market had to stand on its own, and we ended up more or less flat, which is not a problem. The Dow looks much worse thanks to Lilly and thanks to its heavy weight in financials as well. So that's going to be the underperformer for that reason.
And Steve, you mentioned Lilly, and of course we are in the thick of earnings season right now, and we've been weighing the impacts of those results and what they're having on the market and investor portfolios. And joining us now to break that down further is Venu Krishna, Barclays head of U.S. equity strategy. Venu, it's great to have you here. As you've just been parsing through Q2 earnings, what's been sort of the headline for you? What stuck out?
Yeah, so I think at the 2/3 rank, when 2/3 of the market cap has reported, the news in the aggregate level looks pretty decent, right? So we're running, the breadth of surprises and the depth of it is wider than normal, which is good. In aggregate, sales growth is running mid-single digits, and earnings growth is actually faster than that, almost 8.5%. So what that's telling you that there is positive operating leverage in the system, which is very good. But I think once you start sort of getting deeper to see what the underlying components are showing, I think there's a significant bifurcation. And on one hand, you have big tech, which is, when we went to the sum of the parts approach to looking at S&P a year and a half ago, that's when we created this concept. That is just blowing numbers away, right? So once again, we saw, without NVIDIA even reporting, you saw earnings growth of 27%. You saw the magnitude of beat at 12 percentage points. Mm-hmm. And you also saw net margins improving by almost 200 basis points. That is a pretty stunning statistic for a group of stocks which are exceeding $18 trillion right now.
Well, and you highlighted in your most recent research now, you were looking at one chart that just shows the surprises, right, of big tech versus the other stocks in the S&P 500. And we've talked about this concept before, but is that part of what supports the consistent bid in big tech? Is not only do they surprise, of course, they surprise more than the rest of the market, right?
That's part of the story. But I think the tech story is very, very interesting, and we've spent a lot of time thinking about it. So for example, the standard refrain and the concern of people that they're very expensive, right? So on an absolute basis, that is true. But if you look at the trend over the last 2 years, their multiples actually have been steadily declining, moderating. On the flip side, their earnings have remained quite strong. So they've moderated from extremely high levels. they were printing in the 40s percentage growth, now to in the high 20s and 30s. So what's happening is they continue to grow into their multiples, and the street has been consistently underestimating their earnings power. That's why quarter after quarter, we have been a lot more positive on them. And I think since Q4 of 22, when they had bottomed, they were just recovering, that's when we went very positive on that. So that story is very intact. And what's even more interesting in that segment of the market is people are pointing to this dichotomy between them laying off people and yet posting great numbers. And part of the reason is while the rest of the economy is waiting for AI's impact to be felt in a more tangible manner through either increases in productivity or how it affects margins or top line, big tech is already implementing it in their core businesses. In other words, what that tells us that if you are a tech native business or you're a tech centric business, chances are you're already seeing the impact of that. And the reason is quite simple, because one thing we know, based on what companies have told us, which are very tech-centric, the software productivity has improved 30 to 40%. So that is literally taking out layers of software costs out of your business. And if your business is centered around that, it makes a huge difference, right? So, you are right now in the middle of two mega trends. We were already in a transition towards cloud.
Right.
On top of that, you have AI. So this potent combination is going to be with us for the foreseeable future, and it's happening faster than the previous cycles.
And you mentioned something interesting there, and Steve, I want to get your take on this in terms of earnings season broadly. We've seen bigger moves for stocks, whether they miss or beat or split, right? Stocks are moving more than normal. Mm-hmm. What does that tell you about where the market's at right now and kind of the market mood? And I don't know if there's any specific ones you've sort of been watching that have stuck out to you. But
well, actually, I happened to do some work on this just the other day. And basically, I was looking at it not so much from vendors' point of view of were the numbers better, it was were the reactions better.
Sure.
So again, with about 2/3 of the S&P 500 by weight reporting, more stock, it was like 48% by weight were down as opposed to up, and that's been consistent. So in general, it's telling me that the markets have priced in a lot, but they love surprises. So Meta, Microsoft, they loved them because when you have this giant company that can surprise on the upside, they loved it. Although Alphabet surprised on the upside, and we got what, percent out of it. Mm-hmm. So. I think in general, the smaller components of the S&P 500, which by the way is extraordinarily top heavy. Mm-hmm. So there's 400 or so components that have like 0.1% or less, give or take, 0.2% or less, give or take. And you saw some more extreme moves on those because I think just the ability to surprise was greater because there's less focus upon them. There's less. When I look at the big companies, the options market's priced in the moves dramatically for all these. And some of these smaller companies, there's just less money priced in, so there's more room for surprise.
And the other thing that's been interesting too has just been the impact of, I've sort of been tracking this on a case-by-case basis, but the rally you've seen in a stock off the bottom and then how it sort of trades right after, right? You think of AMD comes out about inline print. I don't think there was a ton to really hammer them for, but the stock fell 9%. It had been up 45% going into the report. Yeah. And so I think you're just seeing maybe investors be a little bit more scrutinizing at this point in the rally. We're near record highs.
I think in some cases we've outkicked the coverage, so to speak. And so that's what happened with AMD. But then considering the market's love of buying dips, can't miss a dip and can't miss a rally that's to be chased, AMD got much of it back today.
Yeah.
So again, the market is just looking for these buyable dips and jumping in. Over the past week, prior to Tuesday was the last time I looked at the numbers, the most bought stocks on our platform were UNH and NVO on a net basis. So
United Healthcare's down 50% this year or something like that?
And it was just after their latest reports.
Yeah.
And so, I do have to wonder when, trying to buy a dip becomes trying to catch a falling knife. Mm-hmm. But it's very emblematic of what we see. So even the dips are getting bought very quickly, even if there are disappointments in many cases.
And Venu, let's round this out with sort of your macro outlook into the end of the year and maybe, I don't know, beyond that, right? Yeah. The next 12 months. Do you think this can continue, this sort of vibe that we're having in the market?
I think it can, but I think there's a nuance to that. In the short term, we wouldn't be surprised if there's some choppiness, because one of our concern has been that the market has got too optimistic and has moved up too fast since bottoming in the post Liberation Day announcement. And I think if you look at other parts of the market, obviously, our team does equity-linked strategies. So one of the things we have created, and I think we discussed it once in the past, something called the Equity Euphoria Index. And the idea was to look at liquid options market and to try and see what proportion of a fairly large universe of 1,000 stocks are exhibiting euphoric behavior. And till recently, till the NFP print, that number was at 13%. And that was more than double the longer term average. And we're talking about the averages going back to the 90s. So there's a significant portion of the market in which the level of optimism is running very high, which sort of concerns us. And then see what happened with the NFP print came. In other words, the market became less and less macro sensitive. And then all of a sudden it became very, right? So if you look at what the options market were pricing going into the NFP was moves broadly inconsistent with long-term averages. Sure. In other words, no big surprise. Well, you got a massive surprise on the downside.
Right.
And so things have moved. So one of the concerns I have is we are a fully valued market. We are not saying it's rich. In fact, the part of the market outside the S&P is where we have more concern because that is where the earnings growth is actually running weaker than long-term averages. Going into this print, numbers were cut more aggressively than long-term numbers, though they were not cut bad enough to mirror what you typically see in a shallow recession as well. So, but I think the second leg to it, why we remain optimistic, is that I almost feel that this year has been completely dominated and taken over by the scale of policy uncertainty. On top of that, you got geopolitical risks, which cropped up again. Now you're past both tariff uncertainty and geopolitical uncertainty. And as we enter next year, in a world in which we expect economic growth to moderate but remain better than this year, where consumption improves but is worse off than pre-pandemic averages, and where inflation sort of eases into the right direction but remains sticky. In other words, higher than what the Fed expects. In such an environment, we still estimate earnings will be up 9% next year. In other words, accelerating from where we are this year. And if you look at consensus, that's looking at 13 to 15%. I think that's way too optimistic. But for all the chaos, the underlying fundamentals are decent. The one big sort of uncertainty, which we said, this is the first quarter we said, where you'll start seeing initial tangible signs of tariff impact. Right? And where will we feel it more? We felt that is going to be visible in the consumer-facing segments, which is discretionary, staples, areas like that, and some other areas like industrials, for example, And so we're already collecting data. We're doing work on that. Looks like industrials are able to handle it better, at least in the short term. But the consumer-facing segments are already facing trouble. So some of them are already in a pickle because they raised prices enormously after COVID. Remember, COVID was a one-time opportunity to raise prices without fear of a competitive reaction. So that fattened your bottom line. Companies were in great shape. But now you're running against demand inelasticity, or the elasticity of demand, right? And so if you thought it was becoming more inelastic, that's not the case, because the consumer is on the margin under pressure depending on what cohort you're looking at. The middle and the higher income are doing fine. That's why those consumption patterns are great. But as you go lower, then they are making choices. Because in aggregate, if you think about it, prices have increased 30-40% in aggregate after COVID. Right? Your wages haven't increased at the same pace. So even though inflation is coming down, the accumulated impact of price increases does bite. Home prices still are up 30-40%, even as we said, even as we talk about the housing market being sort of weak right now, right? So I think a lot of post-COVID normalization and the impact of some of the massive policy changes we are undertaking, and the fact that outside of financials and tech, right now, most sectors are actually earning less than the long-term averages. And three sectors, in fact, I think it is materials, it is utilities, and energy, they're going to see earnings contract.
A trend we got to keep watching.
Right?
Yeah.
So this is not as clean as it seems.
Yeah.
But when you keep talking about aggregate, that's why tech is so important. It keeps bailing out the market, and it remains on a very strong. But you wonder that when do the law of large numbers start kicking in at these levels? Or are we going into a world which will become highly concentrated, in which the earnings power and their breadth of businesses is truly massive and very difficult to dislodge.
It's a trend we're going to keep watching, Benny. We got to leave it there. I appreciate you coming in studio today. Thank you.
Yeah.
An important story we've been following that's breaking to tell you about. President Trump posted he's made a decision on that vacancy on the Federal Reserve's Board of Governors. Let's get straight to our Fed correspondent, Jennifer Schomburger, for the latest. Jen.
Josh, President Trump has nominated Council of Economic Advisors Chairman Stephen Miran to replace outgoing Fed Governor Adriana Kuglar on the Federal Reserve Board of Governors. Miran will hold that seat, however, for just a few months until that term is slated to end on January 31st. The president is continuing to look for someone to replace that position for a full 14-year term that would follow after January 31st. The president posting on Truth Social moments ago that, quote, "In the meantime, we will continue to search for a permanent replacement. He has been with me from the beginning of my second term, and his expertise in the world of economics is unparalleled. He will do an outstanding job." Miran served as an advisor to former Treasury Secretary Stephen Mnuchin under President Trump's first term. He was also a senior strategist at Hudson Bay Capital Management and holds a PhD in economics from Harvard University. This coming after Fed Governor Kuglar unexpectedly announced last week that she will resign from the Fed Board of Governors effective this Friday, August 8th. Again, that term not set to expire until January 31st. Kuglar expected to return to Georgetown University as a professor. Now, Miran will still need to be confirmed by the Senate, which is currently on August recess. So it remains to be seen whether he will be able to be shepherded through the nomination process and confirmed by the time of the September FOMC meeting on September 17th. It would have to be pretty swift. But if anyone could pull it off, perhaps Senate Banking Committee Chair Tim Scott could do that. Now, again, Miran is just looking to be a short-term holdover, so this does not look like it will be the president's pick for the next Federal Reserve chair to replace Chair Powell. The president has said he has narrowed that list down to 3 people, including Kevin Warsh and Kevin Hassett. But Josh, the news today right now is that Stephen Miran is going to be nominated to replace outgoing Fed Governor Adriana Kuglar to the Federal Reserve Board of Governors.
A developing story we'll keep watching. Appreciate you bringing that to us, Jen. Gilead reporting second quarter earnings just moments ago. Here to break down the report is Yahoo Finance senior health reporter Anjali Kamlani. Anj, what's going on?
That's right, Josh. We got news out from Gilead. They did beat on their earnings, both on earnings per share as well as on revenues compared to what Wall Street expected. Not by much on the revenue side, but that's something to keep an eye on because they did also raise guidance on these results, saying the first half of the year was pretty good. Both, I got a chance to speak to the CEO, Dan O'Day, and he was pretty bullish on the company and moving forward. All areas of the business, including HIV, where they are the lead, continuing to grow despite facing patent cliffs. We know that many companies are facing that, including Gilead, but they have been making a number of deals. I did also talk to him about the deal making and about China in particular. That's something that has been sort of a topic of conversation, if you will, for many pharma companies. And he said, quote, "The level of science in China is going up and the level of new targets that are available is going up. So deal making in China is going up, and that is for Gilead as well as across the board for a number of companies." And despite that patent cliff that I was talking about, they seem pretty confident that they'll be able to backfill the hole in revenue expected from that drop off with whatever deals are coming in.
Andre, we also got Eli Lilly earnings earlier this morning. That stock got crushed today during the session. What did you see there, and how does that sort of affect its competition with Novo Nordisk and the space as a whole?
Yeah, surprisingly, that drop, as you can see on your screen, down 14% at close today, and that is one of the bigger drops we've seen for the company. We know that it was, a favorite to kind of be the first $1 trillion healthcare company, but that seems to be a distant dream now. And this is not based off of earnings. Earnings came in much stronger than expected, more than $1 billion, almost $1 billion more in sales than what Wall Street anticipated, based off of those GLP-1 sales. But the next generation, it is what is hammering it right now. The pill and the results from a late-stage trial are what pressure the stock today, and that is really going to favor Novo Nordisk, which has been suffering. It has been losing ground to Eli Lilly with its injectables, and now with these results, Novo Nordisk could actually end up taking the lead. We'll just have to see how that pans out with the two companies both having a pill available ready for FDA approval sometime in the next year. So that really heats up the competition again in a time where sort of Eli Lilly was expected to kind of take the lead and take the market altogether.
Something we'll continue to be following. Appreciate you bringing that to us, Anjali. Pagaya reporting a beat on earnings and revenue for the second quarter. The fintech company highlighting record performance across its key metrics while lifting its full year guidance. The better than expected results come as shares enjoy gains of over 200% so far this year. For a closer look at the company's growth, let's welcome in Pagaya's CEO and founder, Gal Krubner. Gal, just talk to me about the year that you've been having, the quarter you just had, the growth story at this point. What do you think has been getting the market so excited about what you guys are doing right now?
So thank you very much for having me today, Josh. Put it simple, I think just it was a moment that everything came together. From people understanding what we're doing, which we'll talk in a second about, from moving to GAAP net income for 2 consecutive quarters, from the 30% year-over-year growth that we have shown, and really the market starting to appreciate that the concept of us helping banks and lenders to be able to approve more consumers, especially in days like this, especially when tariffs are going on and the macro could be in different stages, it is a very strong and powerful value proposition.
And there's an AI part of your story too. How are you utilizing artificial intelligence to sort of drive these results?
So as you know, everything these days is AI, right? We started that much earlier, call it in 2016, but we have developed a very strong tools to be able to look through in the data of the consumer that exists in the US and to be able to provide credit with the power of AI, with the unique data that we are capturing through a network that we have of 31 different lenders, and to find many borrowers that are being overlooked by the traditional financial system and therefore not getting the credit that they need and the credit they deserve.
And talk to me about the scale of that then. Are we still in some version of early days then, as that sort of continues to grow?
So you always can look on it from two sides, right? Sure. From where we started, it's been a very high scale. We're originating something like $10 billion a year. We provided to over 2.5 million people loans so far. We are providing loans both on the personal loan, on auto loans to help people buy cars, on point of sale to help them buy different things on the merchants. But at the same time, where it can go is much bigger. We are in the belief that actually every bank, every lender should have a version of extended platform, a version of an off-balance sheet capabilities. And what is very unique in Pagaya is that with a simple API that is connected to that bank, we are allowing him to have that type of capabilities. And that's the unique piece about what we do.
One thing we've been talking about really all day on the show here with Steve is the different macro headwinds that are in play right now and how that's sort of impacting things. You just mentioned auto loans, you think about all of the tariffs or people going to buy less cars. How does that impact your business if there is a broader economic slowdown because of all the different policies?
So especially in these days, we're becoming even more important because you think about in the situation of higher tariffs or people that are having a hard time getting the loans, then the banks having harder time to lend to them. And therefore, the connectivity to Pagaya and to Pagaya network is a good ability for them to fulfill that credit demand from these borrowers in places that otherwise they could have been able to do it. And how we do it with AI and with the technology. So the ability to utilize a lot of data and therefore to spot the people that actually should get credit even when tariffs are higher, even when the day is a little bit harder, and there are millions of them. That's what the system of Pagaya brings to the front and center of the needs of the banks to know who to give this credit to.
And Gal, I'm curious when you think about sort of the trajectory over the next year or two here. I mean, what are you most excited about, again, to that growth story that you're sort of watching right now, that you're excited about come, we're almost in 2026, right? We're planning for 26.
Definitely. So I think one of the biggest important points of today's earning was really speaking about the guidance. And we increased our guidance from a midpoint of $25 million to actually something closer to 60. So you can imagine how big of a bump it is. And this is a good, I would say, travel of direction for what hopefully will happen in 2026 as we are continuing to build scale, we're lending more lenders, and we are in a very unique set of time in the momentum of our business where more and more banks such as SoFi, Lending Club, LI Bank, US Bank that already working with us, many more are starting to recognize the power of that network and therefore approaching us to start to be able to integrate into that. So for us, the future is bright. For us, we are doubling down on execution and being very focused on that. And hopefully the GAAP net income and the profitability of the company is only going to get higher and higher from here.
Gal, appreciate you joining us in studio. We got to leave it there.
Thank you so much.
That'll do it for today's Market Domination Overtime. Steve Sosnick, thank you so much for joining me today. We really appreciate it. And on the other side of the break, it's Asking for a Trend. Stay tuned.